Welcome to lesson 1.4. I'm CPA Paul Gaido. In this lesson, we are going to learn about branches of accounting. Kindly remember to subscribe to this channel, Treatise of Accounting Information Systems. There are 9 branches of accounting, that is, financial accounting, also known as financial reporting, cost accounting, management accounting, taxation, auditing and assurance, project accounting, fund accounting, also known as fiduciary accounting, forensic accounting, and finally, accounting information systems. Financial accounting. This is the branch of accounting that is concerned with both bookkeeping and financial reporting, mostly to the external parties. We are going to learn about these external parties in our video on users and uses of accounting information. Bookkeeping involves correction of source documents, recording of journals, classification in the ledgers and the ledger accounts. On the other hand, financial reporting deals with preparation of trial balance and end-of-year adjustments, preparation of financial statements and financial reports, and preparation of financial ratios and statistical ratios. Financial statement for financial reporting includes statement of comprehensive income that shows trading profit and loss and appropriation account, statement of financial position, commonly known as balance sheet, cash flow statement, statement of changes in equity, disclosure notes to the financial statement, value added statement, and statement of budgetary compliance. Cost accounting. Cost accounting is a branch of accounting that is concerned with estimation, classification, and control of costs for internal decision making. It is a field of accounting that measures, records, and reports information about costs. Cost accounting is useful in making decisions regarding whether to make or buy a product, to accept or reject a special order, to sell an item as semi-processed or to process it further, to retain or close a line of business, to outsource or hire personnel, and when setting minimum prices. The third branch of accounting is management accounting. Management accounting is a branch of accounting that uses both financial and non-financial data in making decisions. In management accounting, both qualitative and quantitative data is used to make futuristic decisions. It uses financial accounting reports, cost accounting reports, and other non-financial reports to help in making decisions. Management accounting decisions involve policies and strategies formulation, planning and controlling, forecasting and budgeting, budgetary controls, pricing and transfer pricing. The fourth branch of accounting is auditing and assurance. Auditing is an independent examination of the books of accounts and the vouchers to ascertain as to whether the correct books have been kept and to form an opinion on whether the financial statement drawn therefrom shows a true and fair view. Therefore, the 3 main laws of auditing are to ascertain whether the correct books of accounts have been kept, to ascertain that the financial statements are drawn from these books of accounts, and to form an opinion on whether the financial statement shows a true and fair view. The fifth branch of accounting is taxation. A tax is an involuntary and mandatory levy made by government and government agencies. Taxation is therefore the branch of accounting that is concerned with assessing, correcting, and paying taxes as well as compliance with tax rules. Government and government agencies levies taxes on various tax bases. For instance, taxes levied on incomes are pay as you earn on personal incomes, corporate taxes on business incomes, rent income taxes on commercial property rent, withholding taxes on dividends, interest, and royalties. Taxes levied on consumptions are sales tax, value added tax, excise duty, and import duty. Taxes levied on assets are capital gain taxes, wealth taxes, property taxes. On asset, government allows capital deductions in form of investment and wear and tear allowances. Taxes levied on transactions are licenses and permits such as business licenses, fees such as boat handling fees, levies such as development levies, and stamp duties. Tax rate can either be specific or ad valorem. A specific tax rate is whereby a fixed amount of tax is charged. For instance, an excise duty of 10 shillings per unit. An ad valorem rate, on the other hand, is whereby tax is according to the value, such as turnover tax of 5% of sales. The sixth branch of accounting is fund accounting. Fund accounting is a branch of accounting that deals with accountability of resources whose use have been limited by the fund provider or the fund owners. Such funds include donor funds, government grants, trust funds, pension and provident funds, mutual funds. Fund accounting emphasizes more on accountability rather than profitability. It focuses on showing how money is spent rather than how much profit is earned from that money. Fund accounting also consists of a set of self-balancing accounts that are normally used by non-profit making organizations and government institutions. There are three types of funds. The first one is a revolving fund. A revolving fund is a fund that is continually replenished when withdrawals are made. To maintain the same level of fund, the fund provider keeps on replenishing what has been utilized. The second one is endowment fund. An endowment fund is a fund that is not utilized but rather invested, and the future returns generated from the investment is utilized to meet certain objective. And the last one is sinking fund. A sinking fund is a fund that is utilized fully without being replenished at all. Funds can be broadly classified into four. That is, general fund, special purpose funds, investment funds, and fiduciary funds. General fund is a fund that does not have a specific use, such as consolidated fund in government or accumulated fund in non-profit making organizations. Special purpose funds is a fund that is set aside for a specific use, such as project, emergency, or capital redemption. Investment fund, or proprietary fund as it is referred in government, is a fund that has been invested to generate returns such as mutual funds, money market funds, fixed income funds, and also balanced fund. Fiduciary fund is a fund that is held in trust for others. Fiduciary funds accounting is a special way of accounting for fiduciary duty. A fiduciary duty is a legal or ethical relationship to manage assets of another person. Fiduciary accounting involves handling of accounts managed by a person entrusted with the custody and management of property of or for the benefit of another person. Examples of fiduciary funds accounting include trust and executorships, what we normally call estate accounting, accounting for pension and provident funds, accounting for custodial agencies' assets, and accounting for receiverships. Fiduciary funds owners requires the fund managers to maintain records of funds accounts that include statement of fiduciary net position and statement of changes in fiduciary net position. The seventh branch of accounting is forensic accounting. Forensic accounting is an emerging branch of accounting that involves court and litigation cases, fraud investigation, financial claim and dispute resolution, and other areas that involve legal matters. It is the whole process of carrying out forensic investigation, including preparation of expert's report or witness statement, and potentially acting as expert witness in a legal proceedings. Forensic accountants have a combination of both accounting and investigative skills. The eighth branch of accounting is project accounting. Project accounting is a branch of accounting that deals with tracking of the incomes and expenditure at the project level. Project accounting, therefore, involves tracking, reporting, and analyzing financial results and implications of a project. A project is a temporary undertaking involving a series of tasks that must be completed to attain a certain specific unique output within the constraint of scope, time, and cost. Scope in this case means project requirements, time in this case means project schedule, and cost in this case means project budget. Projects are normally executed through contracts. There are three major types of project contracts, that is, fixed price contract, cost plus contract, time and material contract. In fixed price contract, contract price is a pre-agreed fixed lump sum amount. Any variation to the contract price requires both the client and the contractor to renegotiate and cannot exceed a certain percentage of the original contract price. In cost plus contract, the contract price is determined by reimbursement of costs incurred plus the contractor's markup for profit. This is appropriate only when the project requirements are not clearly defined. This type of contract has a risk of incurring more cost than expected. Lastly, in time and material contract, the contract price depends on the time spent by the contractor on the project and materials used in the project plus a contractor's markup for profit. The contractor's markup for profit is determined as a percentage of materials used or based on a pre-agreed fixed time rate. These types of contract normally have a guaranteed maximum price ceiling. Project-related cost comprises of contract price, mobilization deposit, retention fees, reimbursables, and project penalties. Contract price is the total agreed amount of money that is payable to the contractor upon completion of the project within the requirements and the schedules. Mobilization deposit is the amount of money paid to the contractor to facilitate mobilization of equipment and site preparation. Retention fees is the percentage of the amount due to contractor that is deducted and retained by the client as a safeguard for any defect or non-conforming activity in the project. Reimbursable costs are the acceptable level of incidental expenditure related to the project that are billable to the client. Lastly, project penalties are monetary charges used by project parties to enforce agreed timelines. Interested parties in a project are client, contract administrator, contractor, subcontractor, and project manager. The client is the person or entity whom the project is being undertaken for. The client is the one who makes payment for the project. Contract administrator is an expert appointed by the client to monitor the progress of the project on their behalf. Contract administrator is responsible for issuing certificate of works completion. Contractor is the person or entity engaged by the client to execute the project. The contractor is the one who receives payment for the project. Subcontractor is the person or entity contracted by the contractor to perform a specific task of the project on behalf of the contractor. Finally, the project manager is the team leader hired by the contractor to run the project on day-to-day basis. Some of the project documentations that are considered to determine the project's cost and timings for payment are Interim Certificate of Works, Certificate of Practical Completion, Testing Certificate, Certificate of Making Good Defects, Certificate of Non-Completion, Final Handover Certificate, and Project Invoices. The last branch of accounting is Accounting Information Systems. Most of our videos will be focused toward this branch of accounting. Accounting Information System is a business processes management approach to accounting. It involves development, installation, implementation, and monitoring of accounting procedures and softwares used in accounting processes. It includes the employment of business forms, directing of accounting personnel, workflow management, and management of accounting softwares. The principles of accounting information systems are stakeholder satisfaction, process approach, data protection, integration, scalability, and productivity. Stakeholder satisfaction is achieved through service delivery innovations such as having a self-care online solution portal. Process approach is achieved by ensuring that accounting softwares observe business rules and workflow management. Data protection involves strengthening the internal controls of an accounting system, such as use of passwords and encryption, to safeguard confidentiality, integrity, and availability of data. An accounting system should be able to integrate all accounting functions within an entity and should also be able to integrate with other systems. Scalability means ability to adapt to changes in size, nature, and complexity of an entity. An accounting system should be able to adopt an increase in number of customers, suppliers, assets, branches, and departments with only a few configurations. Productivity is the ratio of output generated against the inputs provided. Accounting systems enhances efficiency and effectiveness of accounting personnel by making them more productive. Thanks for watching. Remember to subscribe our channel, Treatise of Accounting Information Systems. Like this video, leave a comment and share with others.